Hello, everyone, and welcome to this version of Multifamily Investor Nation. My name is Rob Gallo, and I am your host today for an interesting topic that I know, some of you probably are very experienced at in terms of raising capital versus debt, or excuse me, raising capital for debt versus equity, and what syndicators need to know. But I wanted to kind of get this topic out as part of the discussion just because recently we've seen a lot of different deals out there for people that are syndicators or operators that are raising money, which is what I do for a living now. And so I wanted to kind of bring that topic up. So why don't we go ahead? Looks like we've got, let's see here. Let's just come up here. We've got about 10 people in here. I'm going to open the chat. Just wanted to kind of see from people, have you raised capital before? And if so, has it been majority debt or has it been majority of equity? You just go ahead and type in the webinar chat. And Lizzie, is the chat on? Just wanted to check here.
Yes.
Okay, here we go. Perfect. All right, Jennifer is mostly equity. It's good to know. See anyone else here? Debt? Absolutely. All right. Well, it's good to know that we've got folks that are kind of in both camps here. So again, my name is Rob Gallo. I am the Director of Investor Relations at PassiveInvesting.com. I'll be walking through some content here with you, just kind of give you some of our thoughts and our opinions on what the key differences are. But I really want to leave some time for questions, or if there's just some other conversation to have. So with that, let's kick in to the presentation. So, as I said, I'm a Director of Investor Relations for PassiveInvesting.com. I work with our acquisitions team, our finance team. IR sits under me, as well as investor services, and I work well with marketing. We really like to keep, in fact, we just got off our directors meeting where we meet just to talk about anything that's going on, deals or assets themselves. So we really work closely with everyone, across the board in terms of our departments, just because it's good to kind of hear me to understand what's happening in the acquisitions, or if we're selling something, but also from those teams to hear what's going on in the market and what investors are saying and how they're kind of leaning. So always a good thing to have those conversations that we have. A little bit more about myself. I previously was a consultant for 18 years. I was a healthcare consultant in the space. I'm retired from that, and I've kind of really gone after my passion. So I've been an active and passive investor for 12 years on a couple of Airbnbs in and around the Chicago area. And that's where I live with my family there. There's my family there. We're on vacation there. Unfortunately, my little girl, Sienna, and she'll shoot me because she doesn't want me to show pictures like this anymore, but she broke her arm on vacation. But actually, we had extremely good healthcare where we were, so that wasn't a problem. But my beautiful family, and it's the last day of school today, so got to kind of hurry up so they don't come barge in here for me. Just a little bit of background in terms of what we raised for and what we've done in the past. So we own and operate several different asset classes. Our primary is multifamily. Got about 1.4 billion total assets under management. About 1 billion of that is multifamily. We also do car washes. We own and operate 31 car washes throughout the Southeast. And we also have some focus on a real estate debt fund where we do first position lending for flips and fixes, as well as some other promissory notes, some preferred equity funds, and a actual loan fund called the PIK Yield Fund. I will say that unfortunately, I wasn't here in the boom times, kind of that, aughts to early 2020s. But since I joined the team, kind of in the middle of 2022, well, let me talk about actually what we've raised. So 2022, we raised a total of about $300 plus million. Now, the breakdown of that was $284 million in equity that we raised, and about 30 million in debt. So that's kind of where we were traditionally sitting, where we were. But as 2023 and as kind of the tougher times have come, 2023 and then into 2024, those numbers have really flip-flopped. So in 2023, we raised 48 million in equity, but we then raised 40 million in debt. And then in 2024, we only raised 11 million in equity, and $70 million in debt. And 2025 is kind of looking as a similar aspect for us. But that's really time in terms of kind of what our asset classes are sitting, kind of what we've seen as, a good buy in the market versus, some other, opportunities that we've seen. So we do have a lot of experience in either one of these cases. So what I'm going to do today, I'm going to just quickly go through difference between equity and debt. I know some of you obviously know that very clear, so we won't spend a lot of time on here. The next piece is really investor expectations. And this, I want to spend some time talking about this because when it comes down to it, we're really trying to appeal to investors. Yes, we primarily in certain asset classes or certain things, but the other hand of the stick is on the IR side, right? We also need to know how to talk to our investors, but what it is that they're really looking for, or what it is that they might not know that they're looking for, but they are looking for. Then just some simple debt versus equity considerations, and then we'll take some time to actually go through some questions. So let's talk through very simplistic. This is very easy. You guys probably know this. It's not really a big deal, but an equity versus a debt deal. So at the top level, equity deal, investors become owners and they have a stake in the asset and a share in the profits and losses. Where on a debt deal, the investor really acts as a lender, right? They're kind of like the bank, if you will. They not have ownership in the asset, but instead they receive regular interest payments and a repayment of principal. Now, on a high level, that's what it is. But let's get down into some of the kind of the details that we see here that kind of really differentiate. So put together a little chart for you. Again, not anything that's going to be dynamic or new to you, but I wanted to break it into these areas just so that you had an understanding, because when we talk to investors, we kind of think about this table here and what an investor might be looking for. So let's start with equity here. So equity, when we're talking about returns, yes, first thing is there's cash flow. So a lot of equity deals that you're looking at, there is cash flow, there tends to be appreciation, and then at sale there's profit, so that the investor can realize that appreciation and that profit plus the cash flow. Now, not all equity deals are done like that, right? There's probably some period between when they actually get started versus when cash flow shows up. But the interesting thing here is, again, not guaranteed. In fact, nothing is guaranteed, let's be honest. And it has a higher variability. And I think what we're seeing in the market, really last year and then into this year is, some of the equity deals that maybe were over levered, didn't have the right financing, maybe bought at the peak of some of the valuations. There's not a lot of distributions coming up. So that's one of those areas that then turns into the risk area column here, where it is a higher risk and a higher reward. On top of that, and this kind of gets into the capital stack a little bit, equity is paid after debt. And so when you think about where you are in kind of the basically the capital stack, or the order that things get paid out, the debt is going to get paid first, then the equity piece. So that plays into the capital stack here, which is our third column, our fourth column from the left. But really the equity is sitting, if you think about the top of the stack being kind of that loan, debt, or excuse me, equity is going to be below that. So it's going to get last paid, but it might have the highest potential return if that asset really appreciates. So then from a legal structure, we talked a little bit about this already, but investors are usually members or shareholders. When you talk about kind of what documents they might have that they are signing, there's going to be a private placement memorandum or a PPM. It's going to have an operating agreement in there, and then kind of that another part's going to be the subscription agreement. And that's regulated by basically on the far right-hand corner by our regulatory means that usually it's a Reg D, a 506B or a 506C offerings, where you do have to have a lot of disclosures in terms of how the asset is going to be run, what fees are in there, what rights you have, what rights you don't have as an LP. That really lists that all out in the PPM. And the last thing on the equity side is, again, the taxes. So this is usually what's going to be a K1 that's out there. And really you can take advantage of depreciation. So those are kind of the high level pieces from an equity perspective. On the debt side, it's different, obviously. So if we look at the returns, usually debt is going to be a fixed return. Obviously, there can be some variations at there, the way you structure your debt, but really there's going to be no upside at sale. So usually what you're thinking about is, all right, if you're offering 8% on a monthly payout, it's going to be 8%. You put $100,000 in, you're going to get $8,000 basically that year until a time set forth in the future where you're going to get your $100,000 back. So it's going to be pretty fixed versus what an equity deal is going to look like. Normally, there's no there's really no upside at sale here. I mean, again, there's going to be some structures in there that make little teasers on there or things like that at the end of the deal, but really no upside, but it's more predictable in terms of the returns. So how that relates to risk, obviously, is that you're going to have some lower risk, right? But you're going to have low reward on there. So again, in terms of the capital stack, this is usually going to be sitting at the top, basically could act as the loan on the deal, or maybe it's a mezzanine debt or a promissory note that's sitting behind that actual loan, but still recognized as a liability, which gets paid out before the equity gets paid out. So the debt is really going to sit at the top of that stack. And just like I said, first to get paid, but has a capped return. In terms of the legal structure, so this really is going to depend on how you're structuring debt, but in some cases, it's going to be structured as a promissory note. So basically, a note that's relatively simple that says this is how much money you're giving in, this is the purpose, what it's used for, and then have some other legal writing on there. But compared to a PPM that can be 145, pages, this one's going to be a little bit shorter, 2, even 5, somewhere like that. And another piece here, it's important to understand, hey, is this going to be secured by an asset, or is it unsecured? Because there's a lot of things out there that say, yes, it's secured by the asset, there's a lien on the asset, or in reality, it's not secured by a lien, but it's basically secured, if you will, by the business. So if the business is successful, that's how these other things will be successful. Then on a taxes perspective, typically it's a 1099, it's interest income and no depreciation. So it's important to have kind of these base structures, because when we get into talking about investors, it's completely clear. So probably one of the biggest statements, sorry about that. Probably one of the biggest things I hear a lot when I talk to investors is, I want to invest in an asset or deal that provides high cash on cash return on a monthly basis, gives me full depreciation, appreciates over a short time frame, because I really only want my money to sit there in 3 to 5 years, and is risk free. And I like to call that the silver bullet. Well, obviously everyone would want that. I want that. You want that. Everyone in the world wants that. But it's really about finding out, okay, I need to know who you are as a person, where you're at in your life, and what it is that you're trying to achieve. Because first and foremost, that whole statement up there about that silver bullet, they do exist. They're out there somewhere, and sometimes people get lucky enough to actually take advantage of that, and they hit the market just right, but they're few and far between. And usually what you have to end up doing is looking at kind of your real estate portfolio as multiple different things. Some parts of your real estate portfolio are going to be more appreciation, more depreciation. Maybe there's going to be some upside there. But the other side, you maybe want to think about it as, you know what, there's not that much appreciation, there's no depreciation, but it's going to be more steady for me. And so when we talk to our investors, that's really what we want to get to. So little test here. I'm going to put up investor A, investor B. So investor A, and I want you to put in the chat here who you think would be probably a better product to go into based on kind of what their name here. So in the chat, respond and tell me from investor A, a working professional business owner that has about 10 to 15 years before retirement, looking to be more aggressive, looking to be, get more appreciation and can be in a longer upside. So is investor A equity or debt? What should they be looking at there? Okay, investor A, obviously, I think probably an equity there from Nicole. Yep, absolutely. So definitely when you look at this type of a framework, you really want to understand kind of where they are. So when you're talking about your investor, knowing who they are, what it is that they're trying to achieve, you want to make sure that whatever they're going to be investing in, whatever it is that you're offering and raising for, that matches to me. Obviously, investor B down here, that's a more equity, excuse me, a more debt side of that. So I look at this from a raising perspective, right? I work with some very smart people on the acquisition side. They can come up with some great, interesting offerings with kind of various things and pieces of that. To me, when it comes down to it, I'm basically working with my investors in these two buckets. And it's important that when you guys are actually creating a deal and when you go to raise, you're thinking about, okay, who is this deal going to appeal to? Who do I have in my network or that I'm connected into in another network that is going to fall into investor A and investor B? Because even if, for example, let's say you do have a debt deal, but instead of actually a monthly payout, excuse me, let's say you do have a debt deal, right? And you're like, great, this is debt. I'm going to focus on my investor B's for this. It's going to, they're really going to love it because it's riskless, or it's very, not as risky as an equity deal, but maybe it's accrued earnings. There's some debt deals out there that instead of doing a monthly pace out, they have accrued piece, so that in a situation, let's say as a promissory note, they can line up and say, hey, we're asking for $2 million. We're going to pay you 12%, but it's going to accrue, and we're going to pay out when we sell the asset. So that's kind of one of those, interesting things that, acquisitions or, management team can put together. But is that truly actually going to appeal to our debt investors? Yes, it is debt. Yes, there's a risk-free perspective to it. But if it's not a monthly payout, are they really going to actually invest in that? So when you're thinking about these, putting together deals like this and raising, make sure you have an understanding where your key investor is going to come from. Is it investor A or is it investor B? Now, like I said before, it's not always going to be an investor A or an investor B, but this is where you really have to drive in to know your investor, to understand what it is that they want. So when we talk about some of these key considerations here, a couple things. So and I'm going to follow up on that, what do your investors want piece here. But first thing is, what are you trying to raise for, right? And I would flip this. I'm not going to look at this as a, specifically, what asset class. It's more to the fact of when you're putting together a deal, do you want to give up ownership, right? Do you want dilution of that equity for you? Now, obviously, the LP and GP relationship helps through equity deals and not giving up relationships. But you want to kind of think through some of those other critical pieces. Like, for example, should I raise equity or debt if I think this asset is going to appreciate significantly? Well, hey, probably it's more going to be equity on that side because, hey, there's going to be a large upscale here. On the flip side, think about the cost of capital. If you raise something with debt, that cost of capital is going to be pretty steady throughout the actual deal itself. Where on equity side, that cost of capital could actually grow as the deal increases in value. So it's just some key things to think about there, that what you're trying to raise for. Now, what I already touched on, which is probably the most important thing, is what your investors want and what is they might not know they want. So again, this comes back to that question about the silver bullet, right? When we talk to people, they say, oh, I want this, I want that, I want the silver bullet. But when you actually start to dive down and say, okay, what are your goals? What are you trying to achieve? What are you currently in? What asset classes are you in? Are those more equity? Are those more debt? Because then you get into that second part of the question of what is it that they might not know they want, right? So that specific question, I think, has really been driving a lot of conversations, I think, for the past year and a half, at least for us, because there's a lot of people out there that, again, ask for that silver bullet. But as you start going through what they currently have out there, or what they think about the stock market, then they're saying, I've got all these basically equity positions, and this is doing well, that's not doing well, this isn't paying distributions, blah, blah, blah. But I want this. And it's like, well, have you thought about it of that spectrum of saying, yes, you've got your equity side, but do you have kind of your straightforward cash side? So by drilling down, understanding what it is that their goal is, what they currently have, and what they might not have, that can lead you to understand what might be a better option for them in lending. A couple other points that I find really good as kind of some of these considerations is what's going on in the market. So I think obviously, a great example what's going on these days in terms of stock market and tariffs, no tariffs, whatever that might be. That's going to let us know, hey, are our investors going to be a little bit more cautious with their money? Are they going to be a little more cautious kind of in the cycle of whatever the market is? Or are they really looking more for something that's going to be a more cash flow on a monthly basis, so on and so forth? This reminds me of a call I had, I think, 2 weeks ago with an investor of ours. And it's about an hour and a half call. And I'm not saying everyone should have hour and a half calls with their investors, but we actually got into her equities. We talked about both owning Apple and kind of all of that stuff. And I shared some of the things, what I was doing and kind of how I thought of the market. But lo and behold, the end of that conversation, that led to an investment of $125,000 into our debt fund. So it does matter what's going on in there, and you need to kind of spend that time to get to know your investor to get there. Last piece here is what's going on with other deals. Anytime that an investor, like that little piece of trust, if you know the know, like, trust pyramid, once you get into that kind of trusting phase or start to get into that trusting phase, that's when they start asking you questions about, oh, did you hear about this other deal? Or did you hear about that operator? Did you hear about those things? That's when they're starting to ask your opinion on that. And that's critical to understand, because that's going to give you an understanding of where they are. Maybe they say they're very risky, but hey, they just got burned on an equity deal. So knowing what's going on with some of their other deals, knowing what's going on in the market with other operators and syndicators and deals like that, it's very important for you to possibly consider when you're getting into debt versus equity considerations. So I don't want to take too much of your time here, but just key takeaways. First thing, know your investors, know what they're looking for, and what it is that they want that achieves their goals, or maybe what they might not know they want to help achieve their goals. What are you trying to raise for, right? What is that asset going to do? Is a debt a more attractive piece for you and the investor, or is it more in the equity side? And then the last piece is know what is going on in the market. If it's general stock market, general economy, interest rates, have an understanding of those dynamics, and then be able to relate it to some of their individual pieces. Obviously, if you're not a tax professional, a CFA, don't necessarily provide that type of information, but you can at least provide, hey, this is what I think, this is how I feel about these pieces. And then, hey, if you're thinking about that type of scenario or that type of a risk or risk-free, this is where it's going to help you lie on that spectrum of equity versus debt. So wanted to wrap up here, but really enjoyed having you guys join this. Obviously, we are recording this webinar so you can share it. If you have any questions outside of the ones I'll take here, you can email me at rob@passiveinvesting.com. Thank you. All right. So if you have any questions, please put them in the chat. We do have one. How do you break into the younger investors with passive income? What type of investors do you categorize them as? And many of them have crypto. What do you feel about tokenization and use of crypto? Oh, okay. Well, I'm not going to talk about crypto. um, I have a very more traditionalist expectation of what money is, and I don't really want to get into that at this point. But I think crypto's out there. There's a lot of people in crypto. Good for them. I'm not in there myself. Um, I think how do you break into younger investors with passive income? I think it's another piece to think about. There's some interesting reading just about 401ks. I think there's asking them, do you invest in 401ks? Right. And I would assume a majority of folks do that. I would say that the passive income is kind of another trigger on kind of what they're looking in for. So when you're looking at a new investor that's younger, it's really about building them up to say, okay, over time, this is what you can do. Now, I know that's not sexy, but a lot of times we sit down and we have calculators where we kind of we basically pace out calculations of compound interest and kind of show them, hey, with a 10% compounding interest, this is what you can achieve. Whereas in the S&P over its lifetime has averaged 10% growth, but sometimes there's high swings and sometimes there's losses. And basically in about I think it's 5.5 years, compound interest, actually, it's not 5.5 years. Compound interest at 10% is always going to be 10% average over a lifetime. We actually did the calculation of 8% compounded interest on $100,000 versus $100,000 earning in the S&P. And at 5.5 years, that compounded 8% starts to beat that 10% average interest. Now, obviously, there's taxes and other things in there, but it's just something to really start to get them thinking about that, hey, actually, over this time, it's hard. What is always a hard thing, by the way, is just, younger investors always like to have that quick piece. They always like to have that, hey, I want it to go up, but that's not the case. There is going to be some education there in kind of taking them through that. So that's always something that, we try to spend a lot of time on. Sometimes it works, sometimes it doesn't, but at least it gets them thinking, and you having that conversation with them is going to help them, kind of really start to evaluate that know, like, and trust so you can get into the trust piece. Another question. Oh, nope. You had a question. Maybe have them get a self-directed IRA. Yes, that's another piece that people do, self-directed IRAs that they can do. We work with a lot of folks that are probably towards the end. They've actually taken an IRA or they've taken a 401k and they've turned it into a self-directed IRA. That's usually when they've retired and they've left those plans. But yes, you can actually create self-directed IRAs and really have the power to not only invest in equities like the stock market, but also take some of that money and invest into passive income like real estate and assets that we're talking about. So give it a second for any other questions. No problems, Chris. Absolutely. All right. Well, thank you again, everyone. I hope you have a wonderful day, and thank you for spending some time with me. Bye.